Look at the stock market right now, and you will see a massive accumulation of wealth. Billions of dollars are flowing into the system, almost entirely fueled by the aggressive capital expenditure cycle surrounding artificial intelligence. Retail investors are piling in alongside the institutions, heavily leveraging their portfolios into tech-focused exchange-traded funds to catch the momentum. This creates a dangerous extreme in one-way positioning. The underlying assumption across the board is that tech valuations have exactly one direction to go: up. But when capital clusters this tightly into a single sector, the entire global market becomes highly fragile and sensitive to sudden macroeconomic shifts. While the crowd is watching the latest chip announcements, institutional money is looking elsewhere. They are heavily focused on the 10-year Treasury bond yield. Right now, this specific bond yield is the most important price in world financial markets. This chart tracks the 10-year Treasury bond yield over recent months. In a very short window, that yield has spiked from a low of 3.92% and climbed to 4.52%. Think of the bond market as the speed limit for equities, and right now it is flashing a bright yellow warning light. In theory, artificial intelligence should drive prices down by making operations hyper-efficient. Yet bond yields, which move closely with inflation, are climbing instead of falling. The cause sits far outside the tech world. Real-world geopolitical friction, particularly the closure of the Strait of Hormuz, is creating severe global supply bottlenecks. This chart plots the 2% target against actual inflation. Physical bottlenecks easily shatter the central bank's target, pushing inflation to 4.2%. If we isolate the energy sector, we find the biggest culprit. Energy prices surged by 23.5%. Raw, physical world friction in global shipping and energy markets is currently overpowering the theoretical digital benefits of the AI boom. The new Federal Reserve chairman has actively argued that the AI story justifies cutting interest rates to support economic growth. The bond market, however, is actively rejecting that policy stance. This pie chart illustrates U.S. gross marketable Treasury issuance. To fund ongoing government spending, nearly 85% of recent debt issuance is dominated by short-term Treasury bills. Fearing sticky inflation, combined with an endless stream of new government debt, institutional investors are aggressively selling off long-term bonds. This leaves the Federal Reserve effectively paralyzed. They are trapped between trying to accommodate the tech sector and needing to manage an increasingly expensive mountain of national debt. The relationship here is purely mechanical. The 10-year bond yield acts as the core gravity for all stock market valuations. When the risk-free rate of government bonds rises, capital gets tighter. Borrowing becomes exponentially more expensive for the tech companies trying to build out massive AI data centers and infrastructure. Institutional money looks at this and does the math. They start questioning why they should risk billions on highly valued tech stocks when a perfectly safe government bond now pays a high, guaranteed return. As yields rise, they systematically drain away the exact speculative capital that the current AI rally needs to stay afloat. That brings us back to right now. The market is currently sitting right at that 4.5% yield yellow zone. The reason stocks haven't collapsed yet is that corporate AI earnings are coming in incredibly strong. That raw earning power is, for now, fighting off the downward pull of these yields. The structure of the market hasn't broken, but it is straining under immense pressure. We are looking at a precarious standoff between tech earnings and bond yields. The real danger emerges if the 10-year yield decisively breaks the 5% barrier. Hitting that level forces a severe macroeconomic shift. The Federal Reserve would have to completely abandon any plans for rate cuts and abruptly restart monetary tightening. When that happens, the extreme one-way positioning in the stock market violently snaps back in a cascade of selling. To make matters worse, a slew of pending mega IPOs are waiting in the wings. They will act like a vacuum, sucking whatever remaining liquidity exists straight out of the tech sector. Crossing the 5% threshold doesn't mean the technology itself is a failure, but it guarantees a brutal, near-term financial reset for the entire tech sector. The new reality for investors is simple. Tracking the latest chip developments is no longer enough to protect your capital. The bond market is the inescapable referee for global financial stability. The 10-year Treasury yield is the single number that will dictate whether the AI stock boom lives or dies.